No, we're not changing because of the Fed, although there could be kind of indirect effects depending on the Fed impact on the U.S. dollar, which could be kind of a boost a little bit for commodities. But no, we're making this based on market fundamentals and the lack of financial flows into or out of oil at the moment. So the market is just a lot tighter than we thought it was going to be. Partly that's the sanctions on Venezuela. Partly it's because OPEC countries, particularly Saudi Arabia, are taking a lot more oil out of the market than we thought they would be. And partly because we still have more sanctions coming up when the waivers on Iran get renewed in a couple of months.
So the bigger lever, it sounds like, Ed, in the oil market at this point is the supply control or supply constraints, I should say, as opposed to global economic growth, which appears to be slow everywhere in the world, including here in the United States.
Sure. I mean, we're looking at 1.3-ish million barrels a day of oil demand growth, about 1.3%. That's kind of consistent with about a 2.6% level of global GDP growth. Nobody's expecting a recession to take place. Nobody's expecting a big increase in growth, even dependent on the U.S.-China trade talks. So demand could be a little bit higher than that, a little bit lower than that. But the really big story on oil is the supply side. Some of it voluntary in the case of OPEC and Russia and some other countries, and some of it involuntary in the case of supply disruptions that are happening and the risks of further disruptions.
Big integrateds are making pledges to spend money in shale country, and so I'm wondering, Ed, how that impacts the forecast for WTI at this point.
Well, we're going to see WTI converging with Brent come what may by the end of the year because of new pipeline takeaway capacity that has kind of bottlenecked the oil from reaching export markets. We should see over 2 million barrels a day of new pipeline capacity that should bring the spread between Brent and WTI down from the $10 range it's been in to closer to $5, maybe even a little bit lower than that. The majors coming in is a long-term story because there's been a lot of talk about lower investment by the independent companies, both the publicly traded ones and the private ones, less investment leading to potentially lower production growth. But we have two of the majors, Exxon and Chevron, that have given very robust guidance for their production growth through 2023 and 2024. If you look at all four of the majors, adding Shell and BP to those, they've now entered the shale plays as well. They're seeing a targeted 3.1, 3.2 million barrels a day of combined production before the middle of the next decade. That's really kind of a considerable floor of a basis of production growth every year. And they've even indicated that the production growth could be higher than their targeted rate, if anything, not likely to be lower. So that's a big change. It means that the U.S. will be less of an accordion as a supplier to the market. We're an accordion now, or we have been, with production rising as prices go up, falling sometimes, or rising slowly when prices go down. And now the majors are in there for the long haul, and they're going to stick to a fairly robust investment program.